If you follow this channel, you already know of the big layoffs sweeping the tech world. But there are also layoffs in the biotech food world. And today we learn that Beyond Meat is not beyond the reach of the current macroeconomic environment. Is the economy really this bad? Or are asset bubbles just being hunted down and popped? Or are companies just using the current period of economic uncertainty to clean house? Maybe all of these factors at play. We know this because this is the subject of the most widely viewed videos on this channel. This video continues our coverage of the wave of layoffs sweeping the United States. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Beyond Meat announced today that it will cut 19% of its employees. That amounts to about 200 employees. The company announced the layoffs in a regulatory filing. The cuts are expected to be completed by the end of the year. Beyond Meat has never been a profitable company, even though it went public. The company showed that the company is making an effort to achieve cash flow. That it does not expect positive operations until the second half of 2023, which is still a long way off. Shares of Beyond Meat are already down 78% so far this year. Wall Street investor sentiment has turned dramatically since June. And investors have no more appetite for unprofitable companies. Many companies who remained unprofitable with the expectation of future high growth are no longer growing. Beyond Meat seems to be one of those companies as the company struggles with declining sales. Share in the company fell on the news of the layoffs and could actually be in something of a death spiral. Beyond Meat stock reached a 52-week low of $12.76 per share earlier this week. The company also announced that Chief Operating Officer, Doug Ramsey, left the company. This comes after he was arrested for allegedly biting a monk's nose. The position of Chief Growth Officer has been eliminated. Deanna Jurgens, who was in that position, will leave the company. Chief Financial Officer Philip Hardin resigned his position earlier this week. Lubi Kutua will take over as Chief Financial Officer. This is the second round of layoffs for the company. They cut 4% of the workforce in a smaller layoff in August. Like many public companies recently, Beyond Meat forward guidance to a range of $400 million to $425 million. The company has scheduled its Q3 earnings call for November 9th. The layoffs are set to be completed by the end of the year. The company will take a $4 million related to the layoffs. They expect to reap savings of about $27 million in cash operating expenses. That just goes to show you how much these people were getting paid. And get this, the company blamed the sales decline on canceled product promotions, programs and introductions. That is a company in denial of reality if I ever saw it. Overall, management cited softness in the market for plant-based meat alternatives. They also blamed inflation and competition. But is it really market softness? Or do people actually prefer real meat? Beyond Meat is implementing measures to drive more sustainable growth, emphasizing the achievement of cash flow positive operations within the second half of 2023, said Ethan Brown, President and Chief Executive Officer. While we believe the current headwinds facing our business and category, including record inflation, are transient, our mission, brand, and long-term opportunity endure, Brown continued. To manage through the current environment and realize the opportunity ahead, we are significantly reducing expenses and sharpening our focus on a set of key growth priorities, Brown also noted. If you follow this channel, you already know that the effects of the current macroeconomic environment are not limited to Beyond Meat. Inflation is raging in most countries of the world. Central banks, including the U.S. Federal Reserve, are aggressively raising interest rates in order to fight inflation. Consumers are no longer confident in the security of their jobs. Add to that, inflation in food and energy are squeezing the budgets of consumers. So, they are dialing back on discretionary spending. In a reaction to that, corporate marketers are cutting ad spending, especially online. And, as you probably know if you follow this channel, online ad spending is the lifeblood of big tech companies. So, the economic and financial sands are shifting tech companies, both big and small. Google and Meta platforms reported decidedly disappointing Q2 earnings. Not surprisingly, both companies revised or revoked forward guidance. Google was still profitable and growing. But top and bottom lines were disappointing. Meta has posted shrinking revenue for 2 quarters and maybe a third quarter as well. And both companies promise to make adjustments in the future. Both companies have hinted at layoffs, but not actually made detailed announcements. Meta has begun quietly pushing out a significant number of employees. Meta has about 83,000 employees, which is 32% higher than at this time last year. Google has 174,000 employees, which is 20% higher than this time last year. Shares in Meta platforms are down by over 50% so far this year. And the market capitalization of Meta has fallen by over $685 billion since its all-time peak in September 2021. But not all big tech companies are adopting the stealth layoff approach like Google and Meta. Snap has publicly announced layoffs of 20% of its employees. This comes after Snap grew its headcount by 65% within the past year and a half. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. Twilio, another unprofitable tech company, is pretty much in the same boat as Compass. Last week, Twilio announced the layoff of 11% of its employees and a broad financial restructuring. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.